right. Hey, everyone. Thanks for joining us this evening at this beautiful, nice, warm Tuesday, January 27th. We're going to let some other folks just load in here this evening before we get things kicked off for Nick. But hopefully, everybody's staying warm. I know that we had quite an adventure here, Sean, in Central Ohio this week with some what feels like record snow and record cold. So, this is a nice little break to get away from all that nonsense here tonight.
Yeah, it's been crazy cold up in Michigan too. The snow days with the kids, I surprised I have any hair left. I don't know. Like this has been, I'm like a week plus 2 days into just school getting canceled constantly. So,
We need fewer snow days. My kids are on
I'm
like an
happy to
extra
talk about
Christmas break.
investments. Yeah.
Yeah, right. So,
Yeah.
um, well, all right. Well, I'm going to go ahead and just kick it off in the interest of time. I know Nick has a lot here that he wants to cover. Sean has plenty that he wants to chime in and talk through. And of course, I'll jump in when and where it makes sense. But thank you, everyone, for joining our 2026 market outlook, where we'll also review 2025. So, joining me here this evening, we've got Sean Carney here, the partner and co-chair here with me. We got Nick Gukin, our CIO, our Chief Investment Officer, and of course we have Ryan Mannon here to help us with any technical difficulties we may or hopefully will not have here this evening. But we really just want to go through, look at what happened in 2025, and talk a little bit about that. And also, look forward to what we see in 2026 and beyond. And the thing that we're hoping here is that as Nick talks through things, sometimes he talks too much, but we'll reel him in, right? But overall, our goal with this is kind of our mantra at Balance. That's to keep investments simple, explainable, and aligned with your values. So we'll dive into an equity deep dive. We'll talk a little bit about bonds and fixed income. One of my favorite parts is the economic scorecard, and then thinking about what's ahead for 2026. So if you guys have any questions during this, just feel free to throw them into the Q&A section or raise your hand. If they're relevant at that point, we'll go ahead and address them. If not, we'll make sure we get to any and all questions at the end. We hope to leave plenty of time for that. Also, if you want these slides, just let us know. You can either, shoot us an email, shoot us a message, whatever works. We will send you the slides so that you can review them and take a look at them and kind of digest them at your own pace as well. But without further ado, I'm going to kick it off to Nick, and Nick, let you kick it off for the webinar tonight.
All right. Hope you guys all are, went to the restroom, got your food, because this is gonna be a really great 3 hour deep dive on investments for you tonight. So we'll try to round
You
out,
wish, Nick.
yeah. Yep, yeah. No, we'll keep it going here. I promise to make this fun and move it along as quickly as we can, but also cover all the good stuff, the reason y'all tuned in. So, first things first, one of the main reasons that we're here is just to look back over 2025. And with that, this chart, I figured let's just get the busiest chart with the most data out of the way. And so starting here, and it's great. It just shows little blurbs of all the different headlines, not even all the different headlines, lots of different headlines of things that move the markets over the last year. And, one of the reasons that we're here for you as advisors is so that you can sift through this noise. You don't even have to tune in if you don't want to. But we're here to help you make heads or tails of all of this stuff. And so, with that, I kind of highlighted a few of the boxes that I think are maybe some of the more important, bigger movers that happened over 25. Like right out of the gates in the spring, we had the Chinese AI model DeepSeek launch that was apparently, way more efficient and cost way less money and power and usage and all that. And so that one spooked markets for sure. And then right at the same time, we had the tariffs on and off, on and off, on and off again. And then we had trade deals, we had Fed cuts in there, we had government shutdowns. It was a busy year, guys. I mean, it
Yeah,
was.
and I'll jump in, Nick. I think when we look at it, there's always going to be a lot of noise in the markets, and it's going to cause fear, it's going to cause panic. And that stretch there from the middle of February to the beginning of April, there was a lot of panic in the market, right? We had people, I think it was just an emotional time coming off an election, and people were saying, hey, maybe we should just go to cash, let's be on the sideline. Our standpoint is always going to be the portfolio is built for this, right? The
Mhm.
portfolio has been through ups and downs. It's been through many, many headlines. It's been through geopolitical contact and tariffs and whatever it can throw at it and survived. And so for the people that trusted us, right, we certainly appreciate it. But the market did take a dip. It bounced back despite all of the kind of the negative headlines.
Yep, yeah, absolutely. So on that note, this is kind of a more of a, play-by-play timeline of the S&P 500, just the market over 2025. So that worst day that you're talking about, Sean, I think, we had, it's like right when our clients really start to feel the pain, like everyone feels like a little, I don't know, it's in their stomach when there's a 2% down day, 1% down day. But when we get a 6% down in a single day, it's like that's when we start getting some phone calls from people getting nervous. And that was it was a big deal. Like you said, it was I don't want to take it lightly when, we talk about percentages all the time, but our clients are looking at, their portfolios and it's real dollars and real big dollar amounts that are moving on these um headlines. So yeah, it was a doozy there. It was about a almost 19-20% drawdown from peak to trough there from February to April. And so yeah, that is a lot, but thankfully the story did not end there. And throughout the rest of the year, it was almost a straight line upwards. And so just breaking it down by the numbers, 41% of the trading days were negative and 59%, almost 60% were positive. And then the best day in the markets happened just 5 days after that worst day. So, and we had almost a 10% up day, which is great. Everyone was like, whew, thank goodness. So, yeah, it was a lot. Like you said, it's a big emotional thing. We see this often, especially the best days being right on the tail of the worst day. So it's the biggest psychological test, right? Like making sure you're not your own worst enemy and when it comes to investing. And so hopefully, I know we were able to keep most of our clients invested throughout this whole journey here. And we thank you guys, like Sean said, for trusting us to have our hands on the wheel through this and guide us through it. So.
And one thing I just want to point out, and this is a little off script, so I apologize, Nick, but another thing that we try to do and we did do for folks during this time is not just sitting on our hands and saying, hey, just wait and everything's going to be okay. But there was a lot of rebalancing that we did through the February, March, April timeline, right? So understanding that, hey, we have certain asset allocations for you so that you can track towards your goals. But as things shift down or up, we will reallocate to get you back to that appropriate allocation. And when you do that in a spot like April 8th and a 50-50 portfolio is down to 40-60 and you rebalance back to 50-50, then you get to participate with more of this upside that we got to see on the back end. So, I think that it really just goes to show that maintaining a long-term view, having a plan, and then sticking to that plan and being proactive with it can really help each and every one of you, all of our clients, be able to, better accomplish your goals and take advantage of these up markets when we do have them.
And some of the other things that we are able to take advantage of is some tax loss harvesting when we get a drawdown like that, and some timely Roth conversions. So those are things that we're looking out for and reaching out to clients and making sure that we're capitalizing on the best situation possible.
Yep.
Yep, yep, absolutely. So it was a busy one on many, many facets. Our operations team were busy. We kept them working. So yeah, I love this chart for those of you that have joined us on these webinars before. I almost always show this one. This is showing the S&P 500 again, calendar year returns over the last, what, 40 years, 20 years, 46 years.
45 years. Yep.
Yeah, so this is again its calendar year return. So the gray bar is where the market ended in that particular year, and then the red dot is the intra-year drawdown that happened at some point in that year. And so even though that 20% drawdown or 19% drawdown that we felt in 2025 felt like a lot. Like actually, it was pretty dang in alignment with expectations. Like it may be a little steeper than the average year, but we can almost guarantee there will be some drawdown in any year. And I'm trying to find a year where there was no drawdown. I don't think there was one. And so yeah, I it was a big year, but also very normal in the sense where this has happened many times before. So yeah. All right. Keep it moving here. So Bob totally stole my thunder on the rebalancing conversation, but
Sorry, Nick.
this line chart I love, just showing some different asset classes. It's not all of them. If I did all of them, it'd look like a bowl of spaghetti up here with squiggly lines. But in general, you can see that there's different areas of the market, whether it's stock market, US, international is the purple line, and then the green line is bonds or fixed income. And so through April, you can see like, hey, look at that. Bonds actually held up, y'all. Like this was a great year for fixed income. It was positive when things were tough and scary. And that by itself created a great rebalance source like we're talking about. So just being able to peel some of the gains off bonds and redeploy it to stocks when they're in a stressed moment is a great move and it worked out well for us. Also having some international in some of our portfolios was great this year. Of course, it's not always like this, and we don't know in any given year which one will be the top dog. But this is great overall for just everything being up, right? Like this is a double-digit type scenario across the board, so we're happy with that. Hopefully, you all are happy with that, your returns this year. So. Keeping along here. All right, I lied. Maybe this chart has more data than that first one. This is a lot, but this one is showing again just kind of more granular look at the different asset classes in the stock market and bond market overall. And just kind of highlighting that we don't know which color tile is going to be at the top in any given year. If we did, we wouldn't diversify. We would just put all our eggs in that basket and get you guys the top return every single time, right? But since we don't have that crystal ball, the best thing that we can do is kind of smooth out the ride for y'all. So the asset allocation, the white square with the black dots in the middle is kind of like a blended portfolio of all of these things. And you can see like, hey, that smoothed out the ride. And that's how you get that kind of middle, hopefully upper middle area of the chart. And overall asset allocation, diversified portfolio. This was the year for diversification. So we are happy again, those international stocks at the top of 2025, but then developed equity was near the bottom the prior year. And so these
Mhm.
things move around a lot year to year.
And ultimately, how this plays out is when we're having conversations with clients, they'll look at it and be like, hey, looks like, one asset class is doing really good. Should we put more there? And we always want to pull up this chart and say, like, it's not always going to be that way, right? And sometimes it's really
Mhm.
hard not to chase those winners, but we've chosen funds in the portfolio that are going to do well at different times, and they're going to do well in the long term. And so we're not going to get into the game of trying to, put all our eggs in one basket just because we think that's going to be the next best asset class. We've got the diversified portfolio and happy to walk you through and have those conversations throughout the year on why we're doing what we're doing. But we want to make sure like if everything did the exact same all the time, there wouldn't be any diversification. So different funds, different asset class perform differently at different times. So this chart kind of highlights the benefit of having a lot of that diversification in there.
Yep. Love it. Keep it going. Keep it going. Look at that. We are moving and shaking here. So, equity deep dive. So, I think this is probably the part that people love the most, the deep dive on stocks. No offense to our bond investors, but the stock investors always like to have more things to stress about, more things to talk about. But some of the questions that we've got the most through 2025 and even right now in 26 is the stock market too expensive? And that's an understandable question, especially after we just flashed a bunch of charts showing how everything is up a ton over the last 12 months. But then what are the major drivers or risks we're seeing in the markets today? And then is AI a bubble is the other kind of big headline we're seeing. So I'll get into it here and make the equity deep dive as painless as possible for you. So, but starting off, we're going back to finance class here and learning about PE ratios, price to earning ratios. And this is probably one of the most, I don't know, talked about, but also probably misunderstood or financial metric that people use when they're valuing stocks. So this is a way to gauge how expensive a stock is or the stock market overall. And so there's two ways to make stocks less expensive. Number one, it could just go down in value, right? Like we saw in April. It's like, hey, stocks were definitely cheaper in April 1st than they were on January 1st. That is true. But then the other way that stocks can get cheaper is the denominator, the earnings can actually go up in a bunch. And so that's actually what we saw through the remainder of 2025. And so when you look at it through this lens, the price to earnings lens, is we're actually exactly flat or maybe even slightly lower today than we were 12 months ago, meaning that stocks are actually cheaper today than they were 12 months ago. And that's kind of a mind-blowing revelation in and of itself, I would say.
Yep.
So,
And the way that I always had this explained to me in simple terms is what is an investor willing to pay for a dollar of earnings? And a lot of times this is used for just an individual stock. Like if we're going to value, Google or Tesla or Meta or whatever it is, it's what is the price over how much of the earnings, right? So, I think that this is really interesting because it takes the overall this PE ratio is of the entire S&P. It says, what is an investor willing to pay for the earnings? And because earnings have gone up so much in line with the prices also going up, to Nick's point, that's why the affordability has stayed the same, even though equity returns were in double-digit returns. So, the relative cost is still equal, which we think is a really good thing for our positioning looking forward.
yeah, absolutely. All right, you guys survived. First slide of finance class. Second slide, this is just really telling the same picture, just a little more color, right? That's good. So this breaks out the S&P 500 into kind of two esoteric categories that have like AI stocks and non-AI stocks. But the gist of it is the earnings growth is the yellow bar is really the only one you need to pay attention to. Is that AI stocks, A, they make up such a big portion of the stock market overall, but then B, you can see that they had just monster earnings growth over 2025. And so even though they had really high double-digit returns, like we're talking about, the overall, price affordability of the market has gone down slightly, which is a crazy revelation. So it's good. It's not all hype, right? There's real dollars, real earnings there. So.
And I
Um,
think I think a lot of that's important because the headlines that we're seeing really over the last couple of months, and they've died down maybe a little bit more recently, was like,
mhm,
hey, there's an AI bubble. There's going to be this could be the next dot-com bubble. And we'll kind of
Mhm.
explain why we don't necessarily believe that. But
mhm.
you can see there's actual earnings behind it, whereas, the dot-com bubble, maybe not necessarily the case.
Yep.
Yeah, yeah, absolutely. So we'll take that away, the dot-com bubble of the, late 90s, early 2000s, where everyone was just slapping .com at the end of their business and then getting this like gigantic premium in the stock markets. They're like, hey, I'm an internet company now. And
Well, first they sponsored a bowl game for their advertising. That was their first dollar they spent.
exactly, exactly. So, um, yeah, so this chart shows the debt levels of the different technology, media, and telecommunications companies over these different time periods. And so in the late 90s, we saw debt levels absolutely explode. And that's because these companies were so early, the internet was such an early frontier, they just didn't have the giant revenues and cash flows they have today. There was no Google or anything quite yet. It's not the same versus Google being one of the most profitable companies today. So the capex or the way that they're investing in AI or investing in the new technology, not being from debt, we think is a really good thing, right? Like we're not seeing a big over levered situation or anything like that. Like have debt levels gone up a little? Like sure, yes, but like not nearly to the extent that we saw in the dot-com bubble. Okay.
Yep.
All right. And just to really beat the dead horse here, these are a bunch of different metrics. I am not going to bore you with every single one of them. We already talked about the PE ratio. But this is again looking at the largest tech companies today versus the largest tech companies in the year 2000, and you can see the price to earnings. Now that we know what that is, cheaper today than they were back then. They are more profitable and they have higher profit margins. So just overall, they're making more money today than they were then. So it's a very different dynamic, even though, anytime we see this massive breakthrough in technology, it's understandable and warranted. People have some scars from the tech bubble, right? And it's good to have some level of pessimism when anything comes around, right? That's always good.
Hey,
But yeah, go ahead.
hey, Nick, just real quick, back to the last slide with the AI earnings before we get to, or two slides ago, I guess, from the AI earnings. Is that AI specific earnings or company overall earnings? Can you just clarify that quickly before we keep moving?
Yeah, this is company overall earnings. And so, the fine print here, it takes the S&P 500 and then it's isolated 46 companies that are most influenced or most in the AI vein right now and put those in the left column and then put the other, 460 or whatever in the right column. And so this is the whole company as a whole, not just earnings relative to AI, because those have yet to really be fully realized. So that's a great question, great point. But yeah,
Yeah,
so keep going
yeah,
here.
and yeah,
All right. So um, I love this chart. This is kind of a less traditional chart, but this is showing the Google search history hits of the term AI bubble over the last year. And you can see that the AI bubble phrase was searched a ton. It peaked there like in October and it kind of came down. So we would argue that it turns out the number of AI is a bubble headlines was the bubble more than AI itself. So,
I love that chart, Nick. Right, like everybody's searching for it and just drops off. So that's the bubble.
yeah. Then the next thing comes on to Google search, right?
Hmm.
Um, all right. So this slide, I love it. One of our favorites in the presentation, I would say. But it's comparing the infrastructure development of refrigeration in the late 1800s, early 1900s, and how I think Chamath says it best. The people who invented refrigeration made some of the money, but most of the money was made by Coca-Cola, who used refrigeration to build an empire. LLMs or chatbots or ChatGPT, those AI tools today, are like refrigeration, and the Coca-Cola has yet to be built. So I think I agree with that phrase. I think we're still really early in this. I think that we're in the infrastructure layer here, and that if you think even going back to the 90s, it's like the internet was a really big thing and did warrant a lot of hype. Maybe not, massive multiples on the earnings, but it was hard. It's even hard to imagine companies like YouTube or Facebook. It's like we had an internet without YouTube, Facebook, and Google, right? Like that's great. Those are empires today that didn't even exist until the infrastructure was built. So I think we're early here. I think there's a lot of a runway still ahead, and we're not in a dangerous zone quite yet. So,
I'd also like to point out, like these are also the time that we see some sharks come to the surface, right? Whether it be AI stocks or marijuana stocks a couple years ago, or non-fungible tokens or dot coms. People are going to come out and say, "Hey, I've got the latest, greatest thing," and we always want to be wary of that, right? When we're buying these stocks, we're doing it through funds in a diversified approach. We're not over leveraging the portfolio. We just want to highlight that there's a lot of noise out there, and we want you to know that not all of it's warranted. And then ultimately, right, be careful because you're going to hear stories from people at the gym or the golf course or whatever it may be about, hey, they've got this new hot pick. And more likely than not, it's not going to work out. And so we always want to kind of make sure that you're wary of these things, not get too excited about, kind of this presentation. And always, we're always willing to have a conversation with you if you want to dive deeper.
Yeah. And I think that's a great point, Sean. I think that what we're trying to highlight here are just some of the important factors or important things that we are looking at that, well, more than anything, Nick is looking at as he's, keeping an eye on the investment strategies, and that it doesn't mean that we're going all in on any one thing or another, right? Just these are the hot topics right now. understand that we are doing our best to stay on top of it and taking allocations to some of these as it makes sense, but not rushing to it, not doing anything that, is throwing all of our risk calculations to the wind or going outside of your financial plan. It's still focused on the long term, but understanding and getting a feel for these trends is such an important part of what we do, even if we don't make any big bets on it now or any point in the future, right? Just understanding it and helping us to kind of share what we're seeing with you all.
Yeah, absolutely. And yeah, it's a great point. Like I'm talking a lot about AI. It's not the only thing we're investing in for sure. But it is a big part of everyone's portfolio, just through the diversified funds that we have because they are becoming just tech funds in general, tech stocks becoming a bigger and bigger weight of the overall market. So
Yep.
this is just kind of peeling back the onion a little bit. So. All right. So enough of the, cool stock stuff. Let's dial it down a little bit, talk about some fixed income here. So 2025 was a great year. We already showed the squiggly line, positive year for bonds. It did have a little bit of drawdown, as it does every year, right? It's not the always up 100% of the time investment. But overall, nice, healthy, solid return in line with expectations. And overall, I think this chart also highlights the big outlier here, which was 2022, right? Like many of you were investing with us through that time frame, and it was painful because that was a down year for stocks and bonds. And this just goes to show from that giant spike in interest rates that hurt fixed income investors how rare that was, and how even if we have some fresh scars from being bond investors, it's understandable. It doesn't mean that we just like give up on the asset class as a whole, right? And so we still have bonds across most of our client accounts as they get closer to retirement or looking for ways to de-risk. Fixed income is not broken, not dead. So we still have it.
Yep.
All
Yeah, I
right.
think I think I think that's very important. Like 2022, if you look back 70s and 80s, I know there were people on this webinar that were buying houses at 16 to 19%. That bonds weren't down 13% during those times. That was a very unique outlier. And then ultimately, when we saw the red bubbles of the S&P, they were all over for the negative years. The reason we put bonds in the portfolio is to mitigate that risk. And again, that's why they're not going anywhere. They do what they're supposed to do, but we just did have a recent outlier in 2022.
Yeah. Yeah. All right. So Fed funds rate. This is the short-term interest rate that gets determined by the Fed, which is a government-appointed person, arguably one of the most influential people in the capital markets globally. And this is showing the roller coaster of what the Fed funds rate has been, right? I think it tells a great story of just our nation, our economy, but I won't bore you with a history lesson here. The main thing is that it's in some ways it's good to have the rate above zero, as a kind of like an arrow in the quiver for the Fed. So then when there is the next financial catastrophe, like there was in 2020 with COVID, like rates were around 2.5%, and they were able to go from a high level and lower it down to ease financial conditions for the COVID era. And same thing in 2008, like when there was a great financial crisis, they were able to lower interest rates to make things easier. Versus that era where we were in zero interest rate land, if there's catastrophes happening in here, it's like, well, they already used that arrow. That lever's already been pulled because rates are already at zero. And so today, rates are hovering around that 3.75% overall. And all these dots are just showing, the very smart people who do interest rate projections and them arguing with each other. And you can see, there's general consensus. It's landing around the 3% mark as the long run. That's what they all believe. Trump has been very vocal in wanting the Fed funds rate to be out 1% or less. So I added that to this chart just so you guys can see what an outlier that is versus what the market is expecting. So to the extent this happens, to be determined. But if there is big moves or rates go lower than expected, the market will need to digest that because that's currently not priced in based on this chart. All right. So Fixed income, and we have one great client who's obsessed with money market funds, so I think he'll greatly appreciate this slide. Put it in just for you. But this is showing that money market assets just towering, compiling. This is looking at a snapshot of all the different money markets across denominated in US dollars, so all of them. And when you add them all up, you come up to $7.8 trillion dollars. And that number has not gone down. In fact, it's been rising and looks like it's going to continue rising. But as rates come down, all that cash in the bank or cash in money markets, it gets less and less exciting, right? Like people are pretty happy with 5% on their money market for a while, maybe less excited at 4, certainly not getting real jazzed at 3. And if we go into 2 or 1%, then they may start looking at other things. But that's kind of the key thing here is like as rates go lower, all of this cash that's currently sitting on the sidelines is probably, I suspect, predict it'll try to find a new home, right? Just like we saw this kind of flattened out area after 2008 where money market assets are pretty stagnant. It's because interest rates were 0%. Like there was no benefit to parking money there. So I predict that this is going to flatline as this money starts to find other places to invest, looking for return, looking for yield. So,
Yep.
And
And that could
ultimately,
be other fixed.
go
Yeah,
ahead,
that
Bob.
could be
Yeah.
other fixed income. That could be equity, right? It could be a lot of different things that it flows to. I think the point is that this just shows that there's a lot of, dry powder on the sidelines that is willing and able to be deployed if and when there's opportunities for it. And, this, can help as just a stabilizer generally in the market to, have this 7 plus almost $8 trillion of money market sitting on the sidelines.
mhm.
And during this time period, like our advice had changed, right? The game had changed, so we had changed. From 2008 through 2022, it didn't make sense to have any money in a high yield savings account because you're getting a 1/4%. And so when people would come to us, they'd be like, "Yeah, if you got a near term goal, let's put in a high yield savings account. That makes sense." As that rate, if that rate, I should say, continues to trend down, they just become less and less attractive. And so we would say, "Hey, we're going to kind of go back to some of the old advice, or maybe use a combination of money markets, CDs, bonds, whatever it may be, that we could create that would get you a better return than money sitting on the sideline if rates continue to trend down." And for
Yep.
people that have been putting money in money market accounts, continue to look at that statement, ask what the bank's doing, see how it's come down, because if you put it in there and it was paying 5%, it probably isn't anymore. So it may be a good time to have a conversation.
Yep, yep,
Yep.
absolutely. Cool. So on that note of, what's going to happen with rates, short answer is nobody knows. But these are some of the front runners. This is going to be a big thing in the headlines. The main reason I wanted to include it in the slides here. This decision will get made in like May or June of this year. I think like probably middle of June. And this is a Polymarket snapshot. So Polymarket giving us live betting odds of people guessing on who the next Fed chair pick is going to be. Right now, it's Rick Ryder, who's the CIO of BlackRock. And, we'll see. Some of these people may be more inclined to follow Trump's every wish, and some may be more independent type of personas. Nobody knows for sure, but it's going to be interesting here in June. We're entering a new era of Fed independence or lack of independence. So,
And I think why that's important to you and your portfolios is we could see some movement in June, right? Interest rates have been so important over the last 3 to 4 years in terms of, investment philosophy and again, just looking at money markets and whatnot. When we change that person, it's going to be a change to kind of the status quo. We don't know what that will be, but we're expecting there to be some uncertainty in the markets, and the markets will kind of determine whether or not it's a good thing, a bad thing, or a neutral thing. But we would expect there to be, a change in kind of what we are experiencing come the June timeframe.
Yep.
yeah. Excellent. So, true or false? I should have done a live poll. Sorry, Ryan, didn't give you a heads up. I won't make you throw one together right now. But are non-US investors dumping US Treasuries? This has been a big one in the headlines. Well, you can write your answer down and we will grill you on it in a second here. So the answer is foreign holdings of US Treasuries have been steadily increasing over 2025 and beyond. And in November, adding another $100 billion, $112 billion. So this has been one of the things that kind of spooked people a lot in, I think, April. But overall, US bonds, US treasuries specifically, are still catching a bid globally. And so I think that's an important thing for you all to know because if you're an investor in the US and you have US bonds, it's good to know that there's appetite for those out there. So it's a good thing. Okay.
Yep. Yeah.
Um,
And I think that's something you hear a lot of, right? Like, and when Nick, you shared this chart, I was like, this is reassuring in a way, right? Now there's all kinds of other issues, right? Like that, just our debt obligations and stuff like that, that of course we can point back to. But the fact that this has remained increasing and stable is a good sign.
yeah. All right. So on the note of non-US investors, I'm gonna put my crypto hat on for a minute and hopefully not scare most of you all away. But stable coins are a type of cryptocurrency where the coin has to be backed one for one by a US Treasury dollar, basically. So $1 equals you one stable coin, just for round numbers here. And interestingly enough, the reason I wanted to bring this up is this is a whole new technology, a whole new segment of the market that didn't even exist, 5 years ago. And it's a massive segment of the market already. And the growth has been parabolic, especially with was it the Genius Act and the Clarity Act that are coming into reality here. But again, this is great again for U.S. Treasuries because this is giving a whole new market to help absorb some of the U.S. debt. And so as the US looks to, like currently, we're actually buying back some of our bonds as a way to do quantitative easing. It's nerdy talk. But we can actually refinance. This gives us a whole nother market to give us the ability to refinance our short-term debt by buying back our long-term debt, rolling it in short term, because now we have $300 billion of appetite in stable coins that are doing over Q4 of 2025 did $10 trillion in transactions. Like, it is a giant thing. And this is mostly non-US folk, for the record, like us everyday Americans probably aren't transacting in stable coins. But for a lot of like emerging markets and other countries where their local currency has a 20 or 70% inflation rate, and people just want to pivot from that currency just to US dollars, the stable coin rails, so to speak, is giving them the ability to do that and then conduct transactions in that. So this is a very interesting development here. We're not investing in stable coins, make that clear. This is just something we're watching in the market to keep our eye on.
And Nick, we've got a question from the audience here, just about how the Chinese you know uh, the currency. Sorry, it's escaping me, right? But
Yeah.
replacing the
Well,
U.S. dollar as the global
yeah.
currency, right?
Yeah.
So does this help or take any pressure off in your mind that U.S. Treasuries have kind of another avenue to go to? Does that help the U.S. dollar maintain its status as kind of the global head of currency, or does that, is China still out there that it's going to be impactful for us from that perspective?
Yeah, the global reserve currency conversation could be its own webinar for sure. But it is worth talking about. And I think that who's ever the country that's able to provide the least amount of friction will have the most assets go to it, right? So if the US does a really good job creating infrastructure to allow people to transact in stable coins, then backed by US Treasuries, then people are going to do that, right? It depends how easy we make it for them. And then at the same time, too, a lot of the, trade tariff negotiation tactics have been basically forcing countries to buy our treasuries as well. So that's also in the calculus here. But yeah, as far as like global reserve currency, um, countries may be adding in other assets like gold or silver or cryptocurrencies, but US dollar, as long as we have the biggest military, quite frankly, in the world, hats off to Sean, is definitely what's, I think, going to always give the US dollar a meaningful position in the world uh,
Yeah,
reserve.
I think both those slides, right? Stablecoin demand, U.S. Treasury investment increasing. There's demand for the U.S. dollar, right? As
Mhm.
that increases, that
Hmm.
only makes our currency stronger and more stable. And if another country, whoever it may be, is trying to do the exact same thing and they're still manipulating it, still being volatile, and if it's left to the people, they'll probably choose the more stable currency. And so I think it would only help, but that doesn't mean there's not competition to
Yeah,
to do that.
yeah, absolutely. Great question. All right, so keep moving here. The economic scorecard. So when I was putting this together, I was like, you know what? We need more numbers on this. So I actually left I left in the numbers from the last time we did this update, which was in June of last year. And it kind of helps us just be able to see like what has changed or what's different. And the short answer is, if you look at the status column, basically nothing's changed since June. Like everything is that's good is still good, everything that's bad is still bad. But overall, we're in a pretty good spot in the economy. We're not seeing any like major red flags as far as economic crisis, just based on the key economic data points here. So I have a lot of cool things to go into. I think one of the biggest ones is the GDP number is probably the one that people watch the most, or maybe it's at the top of the chart for the reason, right? And so 4.4% is a crazy print that we got in Q3 2025. The Atlanta Fed GDP Now estimate has us running at a 5.4% year over year growth. And those are just numbers like in a vacuum. It's like, I don't know, it's five better than four. It's like, yeah, definitely. But like what that actually means is that US could be running and growing its economy faster than even like the fastest growing economies in the world, like India or different emerging markets. So to see that from a developed nation is definitely surprising. We'll see, see if that estimate turns into reality here in the coming months. But overall, inflation is according to the Bureau of Labor Statistics, exactly where it was 6 months ago. Trueflation, which is a website that tracks like thousands of data points in real time to measure inflation, has it a little bit cooler and kind of has been having it a little bit cooler than the official numbers. Unemployment up a little bit, not too bad. We already talked about interest rates, wage growth, basically the same. Consumer confidence, still terrible. And manufacturing PMI is slightly worse in December. So,
And I'm gonna steal just a little bit of thunder from what you're gonna talk about in a second, but the only one that jumps out there as poor is the consumer confidence number. And one thing that I want to kind of reiterate or re-bring up is how behaviors can impact our returns so much when it comes to being investors. That we've seen a lot of people that are fearful of the market for many reasons, right? And understandably so. But when that fear overtakes our ability to be able to take advantage of markets like we've had the past couple years, that is a bigger risk to your long-term returns than, really any other decision that you can make. So, it's sad to me, or it's frustrating. I don't know the right word when I see consumer confidence so low, but I know that that's because people are feeling it in their budgets and their paychecks, things like this. And so it's hard to separate kind of the economy from kind of the personal day to day. But our hope is that through these types of conversations and through our help, that we can make you feel confident and comfortable with the investment strategies and talk about some of the reasons that when consumer confidence is low, which Nick will get to, is actually a good thing for the markets too. So, but I'll stop there.
yeah, yeah. King of the Thunder stealing. I like it. Not going to show you the deck ahead of time next time. They'll just, but Yeah, the so back to the GDP number, because I think that again that's one of the it's kind of the top line. It's how much is our country growing? Like what are we doing here? And just kind of a interesting segue off that is there's $30 trillion in measured GDP activity currently. And we are very likely going to start entering into this next era where robots are going to be becoming a bigger and bigger part, whether that's a self-driving car or an actual like, C3PO looking robot rolling around your house. Um, there's a lot of things changing. And what that can mean for the overall economy is absolutely massive. Like this is the total number, even if fractions of this orange bar, fractions of this green bar get shifted into the measured GDP number, that's going to meaningfully push our GDP growth higher, right? And so we are, I'd say maybe not 26, but probably 2027, 2028 is when we're really going to start seeing the robot age come full swing. And so there's a lot of reasons why the GDP, like all else equal, right? Just robots entering the equation can make the economy grow a lot here in the coming years.
And I think, how that plays out for people who are like, I don't quite understand that is if you're, not driving your car anymore and you're like me and I got to drive my kids, 30 minutes away to practice, 30 minutes back, and 2 hours up to Cleveland, 2 hours back, is that I could be doing work or I could be spending money. And so we're going to be more productive, have more ability to contribute to society, than spend time cleaning the house, driving the car, which could spur on the economy and increase GDP is kind of how we see that working.
Yeah, yeah. Even just like leisure activities, right? Like streaming the amount of hours that we stream on Netflix in this country every day is like a crazy number. I should have that stat up. I don't have it. But it's like if you didn't have to do laundry, so you had a robot that just did laundry or just did the dishes or just made dinner, and it's like that freed you up to do other things. It's like, hopefully that time is spent with humans and, like spending time with family, but a lot of it may end up, trickling into other leisure type activities. So, which then goes into the measure of GDP. So that's not even like, delete the whole value of buying a robot or anything like that. It's going to show up in lots of different ways. So, it's going to be an interesting couple of years here, folks. That's all I have to say. Um, all right, so keeping it along on that era of the robots here, I think nobody does it better currently than Amazon and has been consistently growing. This is the number of thousands of robots that are currently in their workforce. And so we have, they've had robots around for a long time. A lot of them are like the little pallet mover types. But they also have their own humanoid robots coming to markets now, and even some self-driving cars too, and delivery drones. Like all of those things are huge, huge items here. So 26, 27 may be the year when they reach corporate singularity, where there's more robots than humans walking around the stores at Amazon or warehouses at Amazon. So. All right, going back to some hard numbers, pivot off the robot thing for a minute here. The unemployment rate, this is a, fun chart to see. And I think overall, like we feel like it's like nobody is employed almost. Like what do you guys think? I think it's like, you see all the things with like these ghost applications on Indeed and like nobody's getting a job when they apply. And so like, is unemployment a big problem right now? And the data says it's actually not a big problem currently. And you can see this is the other interesting part of this chart is we had the smallest little break there in 2025 when we had the lapse of data coming in from government shutdown related activities. So that was the first time that happened, but it's a blip on the radar. We survived. So yeah.
Yeah, I think just from a long-term trend, this kind of helps. Again, what we want to do is provide, there's a lot of fear in the news, right? We're in that 24/7 news cycle. There's a lot of it. Unemployment has been trickling up, but still we would consider it a, fully employed market across America and still well below historical averages and well below some spikes of 2022 and 2008. So the labor market is still very strong in America.
Yeah. Yeah. All right. So that this is giving a little bit of a deeper dive on that consumer confidence or consumer sentiment index. But also giving us, so like here's the latest reading that we pulled up, right? That 52 and anything, you want to be closer to the 80 number is good. And so we're well in the bad territory for confidence. But this chart shows like, hey, what does the S&P 500 usually do when consumer confidence is poor? And you can see like it's actually, kind of makes sense, right? Like if you buy the dip, buy the fear, usually works out well for folks. Versus the opposite, when consumer confidence gets too high, things can be a little frothy, maybe a little euphoric. And so the fact that consumer confidence is down here and that, AI as a bubble has been in the news for so long, I think has put maybe a healthy, maybe a little too far sold here, but maybe a healthy amount of fear in the market might give it enough legs to keep chugging along these next 12 months here.
Well, and Nick, I think it's interesting, and Sean, you pointed this out when we were reviewing it before this, right? Like consumer confidence is almost as low as it was in November of 2008, right? So like, to compare this to one of the worst markets that we on this call have seen in our lifetimes and saying that consumer confidence is at a similar level, it's wild, right? But again, this doesn't mean, correlation doesn't equal causality and all of those disclaimers, right? It just is another data point that maybe things aren't as bad as the consumer might feel, right? Just kind of generally looking at it. And so don't let that get in the way of maintaining your long-term outlook, your kind of asset allocation.
Yeah,
So,
absolutely.
Nick, just going back to unemployment real quick, we had a question pop in before we get too far from it.
Okay.
Question was, do you have a feel for what happens to the unemployment rate once AI ramps up? And I think that I'll kind of start just quickly with this, Nick, and then I'll let you
Mhm.
dive in, and Sean, of course, too. But, I think that AI is not going to necessarily replace everyone, right? There'll certainly be people that get replaced from it, right? Just like, there's not any milkmen anymore, right? But those milkmen just went and found different jobs. That AI is going to enhance the productivity of employees. It's going to create new jobs that we weren't even sure that we needed. And it's also going to create more jobs for highly educated folks that maybe not highly educated in the traditional sense of like a 4-year degree or something like that, but just highly trained in being able to leverage the tools of AI. So I personally don't think it means that unemployment is going to spike just because of AI, just like it didn't necessarily spike because of the internet or any other, technological advancements. But it will certainly, in some cases, replace some workers. But those workers will find new work in a new, different economy, just like they have in many iterations going back over the years.
Mhm. Yeah. I agree with that. I try to be more on the optimist side of the camp versus like we're all going to be unemployed and working for robots. And I don't think that'll be quite the case. I hope that's not the case. And yeah, I agree with Bob 100% on those things. I think even going back to like the Google and YouTube example of the internet, it's like think how many people those companies employ today. And we didn't even know those companies would exist or their gigantic workforces would exist when the internet came out. And it's like there's going to be so much opportunity that we don't even know, right? And that's kind of the beauty of it is we don't have to know. We just know that humans are really good at adapting and pivoting. And whatever the new opportunity set is, I think we'll find ways to build our lives around it. Hopefully, it just raises the standard of living for everyone is kind of the goal or
Yep.
the thesis here. So we'll see how that all shakes out, but I'm not a doomsdayer on unemployment. So
And I'm right in line with that and those guys. Because all the cell phone come around, we saw the internet, and I think Nick's one slide about refrigeration has been built, but how many people made money off of refrigeration? Yeah, some
mhm,
people that sold ice, lost out, but a lot of people that sell food and drive trucks and do all that made a lot of money off of it. And I think AI will lead to more millionaires and more successful people that are able to utilize the tool and advance society.
Yep.
yeah, yeah, couldn't agree more. So what's ahead for 26? I mean, I think we covered a lot of it. kind of leading up to this, like we're in a really good spot currently, and that lays the foundation for a really strong year in the capital markets going into 2026. And so, overall, I have broken down into the good and the bad, or the risks. And so the good is we have IPO season among us, and it's coming in hot. These are going to be some of the biggest IPOs in the history of capital markets. SpaceX, maybe like $1.5 trillion IPO, I think is the number they're throwing around right now. Could be one of the top 10 companies, like size-wise, in the S&P 500 by this time next year. Like that's kind of crazy. So, and then other big companies too. Plaid, Anthropic is a huge one. Massive tech developments already coming to market. So the Google Gemini, the Nano Banana Tech, which is their picture editor, is fantastic. If you haven't seen it, my wife is an interior designer. She uses it already, and it's just changing the landscape of her business immediately. The Claude Coworker, Claude Bot, which might be a real nerd if you know what that is. The tokenization of real assets, just new technology coming, right? Like this could be stocks changing, trading on crypto rails underneath the hood. So just like Google's Gemini tool today, when you do a Google search, it gives you that like AI summary. You didn't have to change your behavior, your workflow to start benefiting from AI. I think a lot of that same concept is going to happen in our industry, financial services, where there may be blockchains running underneath the scenes that just, to you and to us might not look any different, but all of a sudden we're getting instant settlement, or we're not having to wait, over weekends, or T+1 settlement and stuff like that. So the more that stocks come onto exchange, I know the New York Stock Exchange actually is launching a parallel exchange to what it's doing currently, to kind of build out this infrastructure. But it'll be good. Like less waiting. I think everybody will be on board for that. And also, real estate transactions is kind of the other big one. Being able to transact and move houses quicker with all the friction of the title office, that kind of thing. So self-driving cars, humanoid robots, talked about that a lot. I tend to agree with Miss Kathy Wood here. U.S. economy is in the coiled spring state. We're coming into an environment where you're seeing a lot of deregulation, lower taxes. The tax returns this year are set to be some of the biggest. Lower interest rates may not be much lower from here, maybe a lot lower from here, but probably slightly lower. And then just AI overall reshaping the economy bodes well for all sectors of stocks as they find new ways to be productive in their business model. So the risks coming in very near term is probably another government shutdown, it seems. I think this number's up to 80% as of today. So, we survived the last government shutdown and all the ones before it, but still just not great. Capital markets don't love that one. Go
And if
ahead.
I could just comment here, one thing that we always want to make sure everybody is keeping an eye on is for fake news, because literally Nick, Sean, and I went through this, I think, on Monday. And 15 minutes after we got off the call, Nick saw a tweet that said the government shutdown avoided. It turned out to be fake news, right? Like truly fake news. And it's like, all of these things are going to pop up, and just make sure that you're rechecking and double checking sources whenever you see some sort of headline or anything like that, because we're like, man, we're going to have to revamp some of this stuff. And then turns out we don't. So just a side
Yeah.
And
note.
then ultimately with the government shutdown, we went through it. I know there's people on this call that felt it, right, with their
Yep.
with their paychecks and their industry. But when we look at the stock market, it didn't budge. Like that, like they know that it's going to get funded and things are going to continue on. So it's very interesting to us as we've been through these too many times in the last, decade or so, that the markets are like, whatever, government, you're going to pay, people, you're going to get on with your business, and we don't believe you. So impacts kind of everybody differently, but the markets didn't seem
Yeah.
to mind last
Yep.
time.
Yeah, yeah, absolutely. So we talked about the stuff in June. I'm going to kind of pull both these together. So June is going to be an interesting month, and in the sense that it's probably one of the biggest. It'll be the most public lawsuits. They did opt for like a public trial, so it's going to be everyone's dirty laundry out all over the place again. But it'll be Elon versus OpenAI, and OpenAI is the company that Elon actually founded as a nonprofit many years ago. short news is they ended up ousting Elon and turning it into a for-profit entity. And he's suing them for, I don't know, ownership, money, some combination thereof to be determined. But the reason that's important and the reason that can impact markets is OpenAI, which is the parent company to ChatGPT for everyone here. Has struck so many deals with all of the big chip companies, the data center builds, et cetera. And so, if OpenAI doesn't make it, which is common in disruptive technologies, right? Like they might have started with 100% market share, but when you start like that, the only way to go from there is down, unfortunately. And the other thing is oftentimes the first soldier up the hill takes the most arrows. So we see it. We've seen it before, like Netscape with Microsoft, and even Skype with Zoom. Like, how'd you fumble that? And so, like, there's times when like the big first player is not the one that ends up surviving. I think that the market share, the chips, the data center capacity would be absorbed by the other AI players, whether that's Google, most likely, or Microsoft steps in to take their business. We'll see. But just regardless, these are big disruptive factors that are going to be all over the headlines and probably not a super positive thing, regardless of what the outcome is here in June. So just predicting here, it could be all rosy, but we do have our, that might be our statistical 10-15% drawdown may happen, intra-year this year, maybe not in the spring, maybe in the summer. We'll see. But again, these happen all the time. I'm not going to try to time it. Don't worry. And then geopolitics, goodness, we've seen a lot of geopolitics, right? And specifically, the one that I wanted to point out was China invading Taiwan, which has been a threat for a long time. Like this is not new news by any means, but the fact that Trump has been so, I don't know, aggressive in his current moves may embolden China to take some territory that's close to their home, as we've kind of almost basically done the same thing in the US for strategic military purposes or insert whatever the reason is. So there's a chance that happens. I don't think that'll, spark the next World War or anything like that, but it is something that may not be great for financial markets if that happens.
And I also want to point out, like, geopolitical tensions have always happened. We always feel like this time it's different.
Mhm.
But there has been so many things that have happened, since the beginning of America that you would have thought, man, that's going to be, that's going to tank the market. And the market's kept on ticking, right? They may have a pullback, they will adjust, but companies are going to try to find a way to provide value to their shareholders, regardless of what's happening around the world. They'll adapt much quicker and much more efficiently than the government will. But certainly a volatile geopolitical environment.
Yep. Yep. So we always, and Nick has mentioned this in prior ones in the past for those that have been on here before, right? Like we always try to take politics and understand that they do have their impacts, but kind of keep the political things to the side, whether it's, across the world or domestically, right? That we can have all kinds of unrest and uncomfortable situations that are happening. But again, we're trying to focus on the economics. We're trying to focus on how does this impact the markets. And based on what we're seeing, yes, there's always risks there that can cause some short-term volatility. But going back to Nick, your scorecard, I think we're in a pretty good spot as we sit here today.
Yeah, yeah, absolutely. Cool.
So
Well, we have any questions now? I know we were hitting some of them as they came in, but I don't know if we got any other ones that came in as well, Bob.
yeah, I didn't see any other questions that came in. What I tried to do is get them through as we were kind of near or at certain topics. The one that I just said, hey, we'll wait until the end and kind of see what is there. There was one question just on, are there any companies that you're following as a potential Coca-Cola companies in the AI infrastructure being built? And one thing that I want to just tee up to everybody is we do these webinars monthly. And the webinar for next February that we're thinking of doing to have Nick is to do like a deep dive into AI and crypto and less of like hey, we think that you should be investing all your money here, but more just what is it? what's going on, how does it impact our investment strategies, how does it impact the market, economics, etc. So he will dive deeper into that in a really, really nerdy, like this was only kind of nerdy. That one will get really nerdy, right? But I think that that's something to look forward to for February if you're interested to learn more about that space. But Nick, I'll let you take that question if there's anything that you're looking at or any ways we're trying to play that AI space for it to be the next Coca-Cola.
Mhm. Yeah, it's a great question. I wish I knew what that next Coca-Cola was. But I will say that the big companies today that make up the majority of the S&P 500, like Google, even Tesla, and Amazon, I pick on those three. Um, they are so diversified. They're almost like diversified funds in and of themselves. Each one of them is almost like a Berkshire Hathaway, which is like a holding company investing in lots of other companies. And so there's a good chance that the big names today are some of the big successful, the Coca-Colas of the AI era, just because they are so diversified in their business models. Just to name like an example, like Tesla's got the battery storage, the humanoid robots. Amazon, obviously, with a giant army of robots already themselves.
And
Um,
Amazon Web Services, right?
Amazon Web Services, Tesla with the battery storage, self-driving cars, etc. These are all some like the biggest, most disruptive forces of nature. Google, I got to hand it to Google though. 12 months ago, I think everyone thought that AI was gonna just delete Google, right? Everyone's like, oh, no one's gonna use Google search anymore. We'll just use ChatGPT for everything. And they really turned it around and made the Google search experience and have been pushing their AI product, Gemini, into all of their different apps and services. So that's just an example. Is like 12 months ago, us, the market as a whole, like we're like, oh, I don't know about Google. And here they are today, one of the top dogs 12 months later. So yeah, I'll pause there. That I could I'll save some for the
Yeah.
next one. Let me put it
Yeah,
that
and
way.
I think too, as we've kind of alluded to earlier, is the AI companies, the winners in this space, they already have other revenue streams, right? They've already been able to implement their other products. So
Mhm.
much different than dogfood.com in 1999 that we thought was going to change the landscape. That had zero revenue, zero product. So we
Mhm.
do believe it's different there. And then as a shameless plug for that February webinar, like if you don't have any idea what like a Bitcoin is or a cryptocurrency in general, like we want to educate you so that when you're talking to other people about it, that you have an understanding of what that is and kind of as Nick alluded to, when we make a trade, it sells a day later, how we may be able to use some things like the blockchain and other spaces to speed up transactions. And so just kind of a high level, AI, crypto discussion. I think you can learn a lot in February if that's of any interest to you.
Yeah.
Yep. And
Oh,
and so these webinars are designed to be, just informative, effectively educational webinars to fit the meetings between, when we're getting together with you individually and just kind of fill in the spaces, right? Because we had a question come in asking if one-on-one sessions are going to continue as in the past. And, as Balance and Bolt, we've come together and we're trying to do these webinars to help you educate. It does not change whatsoever our interactions with each of you on an individual level. So if and when you have specific questions on anything we talk about here as it relates to your plan, your investment strategies, or any of the above, I speak for myself, but also I think Sean, Nick, everybody on the team at Balance, that we are always here to talk to you one on one, make sure you're comfortable, make sure you understand, but use these as opportunities just to share more information with a large audience that we can get all kinds of really cool questions asked and answered too. So just wanted to make that clear that all of these are purely educational and they're not designed to interfere with those one-on-one meetings that we have with you on a regular basis.
yeah, yeah,
Okay?
absolutely. I think this will just give us more stuff to talk about on those
Yeah,
one conversations, right? So,
exactly. Right.
yeah,
It brings stuff up.
yeah,
So,
yeah.
well, awesome. Well, thank you. I got a question that was a thanks. So thank you. I won't say your name, but appreciate you very much. To everybody that joined on here, Nick, you want to go to the disclaimer so that we make sure compliance gives us the check mark for being good
Yep.
advisors here. Thank you all for being here this evening. Again, if you want the slides, let us know. We're happy to send them over to you. We'll send them over in a PDF. If any of these things piqued your interest and you want to take a deeper dive on your individual plans or strategies, reach out to me, Nick, Sean, even Ryan. Ryan will connect you with somebody. He can't talk about it, but he'll connect you with somebody that can. But it's we're so happy to have you on here. We appreciate this. And if you have any ideas for other webinars, let us know. We want to make sure we're talking about stuff that you guys care about, that you want to hear more about, that you want to hear our voices. So give us feedback. If you want us to do one on, anything, right? Like, we did one on cybersecurity a year ago. That was a recommendation from a client. That was one of our best attended and best reviews webinars that we did. So just let us know. But thank you all so much for being on here. Nick, thank you for taking us through this and not spreading it out for the whole 3 hours. Sean, thank you for being here and having all your great comments. Ryan, thanks for making sure the tech doesn't fall apart. Thank you all for a great day and a great evening. Sean, anything else before we sign off here?
Nope, I appreciate everybody. Thank you so much.
Yeah,
Yep.
we'll give you your last 2 hours back. You're welcome. Have a great night, everyone.
Everybody will get their gold star in the mail
Yeah.
too for being in attendance. Thanks,
Cool.
everyone.